And I'm Mira.
So, over the last 48 hours, big tech scaled back a $250 billion AI project, and, well, one of the world's largest market makers just suffered historic losses.
Right, not to mention we literally saw missiles flying in the Strait of Hormuz.
Yeah, exactly. But, if you just glanced at your portfolio on Friday afternoon, you'd probably think the S&P 500 is celebrating a nice, calm, technical rebound.
It is a massive divergence. So it's Sunday evening, August 16th, 2026, and tonight we're doing a deep dive into why the stock market is acting like the skies are clearing, while gold is basically pricing in an absolute hurricane.
Yeah, our mission here is to unpack all these cross signals for you and provide the broad macro backdrop as we enter the new trading week.
Definitely. And just to set the ground rules before we really jump in, we are here for market context and intellectual discussion. This is not personal investment advice or a recommendation to buy or sell any assets.
Right. We are simply trying to map out the terrain you'll be navigating on Monday morning. So before we get into all the weekend chaos, let's establish our baseline. I'll officially open session 1 and ask, how did the markets move over the past week?
Well, on the surface, the equity story was all about a technical recovery. I mean, we watched the S&P 500 claw its way back from that brutal late July low of around 73.16.
Which is a rough spot.
Yeah, very rough. But it rallied to hit a Thursday peak near 77.98 and eventually closed the week basically flat against that high at 77.85.
Nice. Though the Nasdaq was a much bumpier ride, right?
Oh, absolutely. Wild intraday swings all week. But it did manage to finish just north of 26,729.
But the real standout for me was the Russell 2000. It showed incredibly robust relative strength, closing at a weekly high over 3,068.
Right. So if you are just looking at those equity indices, it really paints a picture of a market breathing a massive sigh of relief. And the volatility index, the VIX, seems to back that up.
Yeah, dropping from 15.46 down to 14.25.
Exactly. But that is exactly where the narrative fractures. You have the VIX dropping, which implies calm. But at the exact same time, you have this spectacular historic rally in gold.
Yeah, that was wild.
It surged past the 4,400 mark to an extraordinary Friday close of 4431.1.
Which, I mean, that isn't just a slight hedge. That is aggressive, defensive, safe haven buying. Equities are shrugging off the risks, but the gold market is screaming that something in the system is under extreme pressure.
And you can see the fault lines forming in the rates and credit markets, too. The 10-year Treasury yield was super volatile all week. It dipped down to 4.61% on Thursday, but then rebounded to close at 4.696% on Friday.
Which is incredibly elevated.
Yeah.
But this is where the plumbing gets really interesting. Despite all that yield volatility, high-yield corporate credit, the HYG ETF remained remarkably resilient.
Very true.
It stayed in a really tight range, closing right at 79.71.
Which is fascinating because, the HYG is essentially a basket of junk bonds. When the market genuinely fears a recession, investors dump high-yield debt because those are the companies most likely to default.
Right.
So the fact that HYG is stable tells us credit markets simply aren't pricing in an immediate wave of corporate defaults, even with the 10-year Treasury hovering near 4.7%.
So to wrap up session 1, we have this massive tug-of-war. Mega-cap tech rebounds and corporate credit are sighing in relief while gold is battening down the hatches.
Yeah, quite the split personality.
Exactly. We're going to take a really short break, and when we come back, we'll dig into the weekend news to figure out why the market is acting this way.
Welcome back. Let's get right into session 2. What happened over the weekend and what are the market implications under our macro context?
So, coming out of Friday's close, our watch next items were our baseline. We were keeping an eye on Strait of Hormuz headlines, Chinese July activity data, and incoming U.S. manufacturing and housing metrics.
Let's start with the domestic data because the consumer slowdown narrative just got a massive data point. July U.S. retail sales fell 0.6% month over month.
Wow.
Yeah, and core was down 0.3%.
That is a significant miss. And, when you pair it with the preliminary August University of Michigan Consumer Sentiment Index, which absolutely plunged to a record low of 51.0, the picture looks grim.
But we cannot ignore the internal contradiction in that Michigan report. While sentiment crashed to 51, the one-year inflation expectations component actually ticked up to 4.3%.
Okay, I have to challenge the neat consensus explanation you hear on the street right now. A lot of analysts are just calling this a standard cyclical demand contraction.
Right, the whole domino theory.
Exactly. They view it as just the next domino to fall before the Fed rides to the rescue with aggressive rate cuts. But look at the mechanics of that data. Sentiment is at a record low, but inflation expectations are rising. I'd argue we are looking at consumer debt exhaustion, bypassing rate cut relief entirely.
Wait, I really have to push back on that, Daniel. You are pointing to a single University of Michigan print to declare the consumer completely exhausted.
Wow.
But if consumer exhaustion is truly systemic right now, why is high-yield corporate credit trading in such a tight, resilient range like we just talked about? The credit markets clearly aren't panicking about a sudden collapse in consumer spending leading to corporate defaults.
Because corporate credit isn't the consumer. I mean, the mechanics are totally different. Most large corporations termed out their debt back in 2021 when rates were near zero.
Okay, fair.
They're insulated from this 4.7% 10-year yield for now. The average consumer, however, is floating on 24% credit cards and auto loans that reset constantly. Corporate balance sheets might be resilient, but the household balance sheet is buckling under the cost of living. That's why sentiment is at 51, while inflation expectations are stuck at 4.3%.
That is a fair distinction. And if consumers are exhausted but inflation expectations remain sticky, central banks find themselves facing central bank paralysis under supply-driven stagflation.
Precisely.
The Fed can't just slash rates to rescue the consumer if they fear reigniting core inflation. And that brings us directly to the physical supply shocks threatening to do exactly that, the geopolitical and energy risks that escalated over the weekend.
The headlines here are intense, and we really have to look at them objectively. The U.S. Iran ceasefire has officially stalled out.
Right.
And former President Trump threatened what he called an unstoppable blockade and a wall of steel.
Wait, didn't he also float declaring the Strait of Hormuz a U.S. territory?
Yeah, he did. And, we must impartially note that this political rhetoric is matching actual physical developments on the ground. A commercial bulk carrier was struck by a projectile in the strait.
And over in Yemen, the Mocha port had to completely suspend operations due to Houthi attacks.
Plus, this instability isn't isolated to the Middle East. Over the weekend, Ukraine successfully executed deep penetration drone strikes against major Russian oil infrastructure.
Oh, wow.
Yeah, they hit facilities at Ust-Luga and the Novorossiysk terminal. Loadings were totally suspended. And Brent crude immediately reacted to all of this, jumping to $88.54.
It is very tempting for the market to treat these events as isolated, unpredictable natural disasters, but we need to challenge that reflex. If you look at this through a game theoretic lens, you realize this geopolitical escalation as game theory brinkmanship is calculated.
Totally.
And more importantly for the listener's portfolio, these simultaneous oil and shipping shocks do not just exist in a vacuum.
Right. They act as a massive multi-channel margin tax on corporate profits across the board.
Exactly. Let's explain how that mechanism actually works. When Brent crude spikes and shipping lanes are threatened, it's not just the price of gasoline that goes up. The cost of maritime insurance skyrockets.
Freight rates double.
Because ships have to take longer routes. The cost of bunker fuel for those ships surges. All of those input costs act as a tax that eats directly into the profit margins of non-energy companies.
Whether you're selling sneakers or semiconductors, your cost of doing business just went up.
Speaking of semiconductors, we have to transition to the other massive structural story from the weekend. The AI CapEx return test. The numbers coming out of big tech are staggering, and we just saw some major cracks in the foundation.
The Nvidia news is definitely the most glaring. They officially scaled back their financial guarantee for the massive OpenAI data center project.
Yeah.
They dropped their commitment from $250 billion down to under $120 billion to ease investor concerns.
The $130 billion haircut is not a rounding error. That is a fundamental reassessment of risk. And at the same time, Nvidia is exploring a $3 billion investment in SB Energy.
Which perfectly highlights AI power demand as the physical infrastructure bottleneck.
Yeah.
It is no longer just about designing the most advanced chips. It's about finding the electricity to actually run them.
Meanwhile, Goldman Sachs is exploring a massive $500 billion AI funding plan for Nvidia to tap third-party capital.
When you see a pivot toward third-party private credit of that magnitude, it tells you the traditional equity and debt markets are starting to gag on the sheer size of the required capital.
Absolutely.
Throw in the fact that the U.S. government is actively pressuring Apple to reject Chinese memory chips, and you can see the margin pressure building from every angle.
We actually saw this tension reflected in some massive institutional moves revealed in the latest filings. We are seeing a complete split in how smart money is playing this.
Oh yeah. George Soros' fund increased its stakes in Nvidia and Apple.
But on the other side, Dan Loeb's Third Point loaded up on Alphabet while completely liquidating its stakes in Meta, Broadcom, and Lam Research.
Selling Broadcom and Lam Research is a major signal. Those are the picks and shovels of the semiconductor world. Unpacking this, I think of the AI CapEx self-referential valuation loop, like a high-speed bullet train.
Okay, a bullet train. How so?
Well, the train is traveling at 200 miles per hour, but it has to lay its own tracks while it's driving.
Right, which takes an astronomical amount of capital.
Exactly. Big Tech is buying chips from Nvidia. Nvidia is using that revenue to justify its valuation, and the market is funding Big Tech to keep buying. But if the market stops believing in the final destination, the actual return on investment, the financing dries up. And a train laying its own track can't just hit the brakes slowly.
It derails.
It derails.
I would add another layer to that analogy. Think of the 10-year Treasury yield like gravity and these mega cap tech valuations as a hot air balloon.
I like that.
As long as earnings growth and AI hype provide enough heat, the balloon can easily defy gravity. But the second you get a supply shock that taxes corporate margins or a realization that the AI rollout will take longer than expected, the heat turns off.
And with the 10-year yield acting as gravity nearly 4.7%, that downward pull is incredibly strong.
Which is precisely why we are seeing these violent intraday swings in the NASDAQ. Risk-free yields act as gravity-compressing equity multiples. It makes these massive valuations hypersensitive to any hint of cash flow disappointment.
Which brings us to the final and perhaps most concerning piece of the weekend puzzle. Market microstructure. We got a rare look behind the curtain at Jane Street.
One of the largest market makers in the world.
And it wasn't pretty. They suffered historic losses in July with their revenue dropping 25% from their June peak. In response, they were forced to close significant risk across their affected portfolio.
Let's explain how that plumbing actually works and why you should care. Market makers like Jane Street act as the ultimate shock absorbers for the financial system.
Right.
When a massive institutional player wants to suddenly dump $500 million of a tech stock, there isn't always a natural buyer waiting. Jane Street steps in, buys the block, and slowly offloads it. They provide the liquidity.
But when a firm of that size takes a 25% revenue hit and has to drastically slash their own risk, that shock absorber is removed from the market.
Exactly. Suddenly, a normal sell order doesn't have a willing buyer on the other side. The gap between what a buyer will pay and a seller will accept, the bid-ask spread, blows out.
It creates a global liquidity vacuum.
There is simply less capital available to absorb sudden market moves, meaning a small geopolitical shock on a Monday morning can cause a massive outsized flash crash in equities or credit markets.
So tying this all together to wrap up session 2, we're looking at a serious collision of forces. Sticky inflation expectations colliding with exhausted consumers, immense scrutiny on the sustainability of AI capital expenditures, a confirmed liquidity vacuum, and geopolitical margin taxes threatening to squeeze corporate profits.
It's a lot to process.
It really is. So we're going to take a quick break, and when we return, we'll look at what to watch in the week ahead.
Welcome back.
All right, let's open session 3. What should we watch in the coming week?
The week ahead is packed. Based on the Watch Next outlook, we can group the upcoming data drops into 2 main themes: growth sensitivity and inflation risk.
Let's start with growth and the consumer. On Tuesday, August 18th, between 8:30 and 10 a.m. Eastern Time, we get July import prices, housing starts and permits, industrial production, and pending home sales.
That block of data is going to be a crucial joint read on housing sensitivity. We really need to see if these high yields are finally breaking the shelter market, which has been incredibly stubborn.
We also get initial jobless claims and the August Philadelphia Fed Manufacturing Survey on Thursday at 8:30 a.m. Eastern Time.
Then on the inflation side, Wednesday is going to be hypersensitive. At 10:30 a.m. Eastern Time, we have the EIA weekly petroleum status report.
Which is huge.
Given all those Strait of Hormuz and Russian oil infrastructure attacks we just discussed, the market will heavily scrutinize domestic crude inventories and implied demand.
Later that same day, Wednesday at 2 p.m. Eastern Time, the FOMC minutes from the July 28th to 29th meeting will drop. We'll be reading the tea leaves on the internal Fed debate over inflation versus rates.
And finally, on Friday, August 21st at 9:45 a.m. Eastern Time, the August S&P Global Flash Manufacturing Services and Composite PMIs are released. That will be a huge, broad growth and inflation signal to close out the week.
Looking at that calendar, Mira, what's your big takeaway?
Well, considering all the cross-currents we've discussed, I want to leave you with a provocative thought to mull over. If structural deficits and heavy Treasury supply are going to keep long-term yields elevated, regardless of what the Federal Reserve does with the overnight rate, how long can equity markets rely on the mere promise of rate cuts to justify record valuations? Especially while physical supply shocks are actively threatening a resurgence in inflation.
That really is the million-dollar question.
Yeah.
Honestly, looking at this setup heading into Monday, my portfolio and I have agreed to a new Sunday night reset strategy.
Oh, really? What's that?
We are simply ignoring any headline containing the words Strait of Hormuz, capital expenditure, or Chinese memory chips.
Good luck with that.
Thanks. I am currently trying to figure out if I should chase tech like George Soros, cut risk like Jane Street, or just buy a literal brick of gold and sleep through the rest of August. Happy Sunday night existential.